are we looking at a falling trend with flashing sell signals, or is this a strong buy that is secretly undervalued?
Yeah, that really is the ultimate question, isn't it?
It is, especially when you are staring at a stock chart that looks like it has just, completely detached from reality. So today, we are pointing our microscope squarely at HIMS and HERS Health. The ticker symbol is HIS.
Hmm.
We've got a massive stack of recent market data, financial reports, technical indicators, and our mission for this deep dive is to help you decode the chaotic forces pushing and pulling this stock right now.
Right. And yeah, before we get into the weeds, I just need to make the ground rules absolutely clear for everyone. What we are doing today is a pure analysis of the provided source material and the current market data.
Yeah.
We are looking at the math, the history, the underlying business mechanics. But, and this is vital, this is strictly not financial advice. We are not telling you to buy, sell, or hold. We are just here to break down the complex mechanisms at play so you can think critically about your own portfolio.
Exactly. We're just looking for the signal in all this noise. And hey, please take a second to like the video and subscribe to our YouTube channel. Also, it is compulsory that you leave comments and feedback below if you want to see more of these deep dives. We really want to know what you think.
Yes, definitely let us know your thoughts in the comments.
Okay, let's unpack this. We have a telehealth company that has been on an incredibly violent ride over the last year, with so much conflicting data out there, the bullish charts, the terrifying headlines, the massive debt. Where do we even begin to figure out if this stock is a hidden gem or a ticking time bomb?
Well, I mean, we really have to begin with the primary catalyst, the massive macro threat that is just completely dominating the narrative right now.
Right, the Amazon threat. So for context, as of April 21, 2026, HIMS is trading at $30.14. That's up about 1.14% in extended trading.
Yeah, but you have to remember, that slight bump is actually just a tiny recovery from a very sudden, very sharp 4% drop during the regular session.
And that drop wasn't just random market volatility, right? It was a direct reaction to a single competitor making a massive move. Amazon Pharmacy.
Exactly.
Yeah.
Amazon Pharmacy just announced their entry into the GLP-1 weight loss market. And they aren't just entering it, they are attempting to break the existing economic model of the entire industry by launching a $1 program.
Wow. A $1 program.
Yeah.
Let's explain why that is so incredibly dangerous for a company like HIMS. Because GLP-1 drugs, these are the injectable weight loss and diabetes medications that have basically taken over the world. They are a huge revenue driver for telehealth companies.
Awesome.
The whole business model for HIMS relies on a markup. You don't just pay for the drug, you pay for the ecosystem. You're paying a premium for the digital consultation, the continuous care, having it shipped right to your door.
Right.
So Amazon coming in and offering the medication practically for free as a loss leader, that's a direct attack on those margins.
It is a textbook loss leader strategy. I mean, Amazon does not need to make money on GLP-1s. They just don't. They want to get you into the Amazon pharmacy ecosystem, tie you to a Prime membership, and then, monetize you in a dozen other ways.
Right. They want to own your whole shopping cart.
Exactly. But HIMS, on the other hand, they have to make money on the medication, the consultation. Their entire business model requires it.
Okay, but let me push back on this doomsday narrative for a second. It's a classic David versus Goliath setup, right? Amazon has a history of stepping into new industries, flexing its massive logistics network, and just terrifying investors.
Oh, absolutely. They've crushed entire sectors before.
Right. But a 4% drop in HIM's stock price, honestly, that feels like a surprisingly muted reaction to me. If Amazon is dropping a nuclear bomb on their core product, why didn't the stock crater by 20 or 30% today?
Because HIMS is no longer a fragile little startup. When you look at their income statement, they have built a genuinely formidable financial engine. The market knows they have the cash flow to absorb some hits, at least in the short term.
Okay, let's look at those financials because the top line numbers are undeniable. Let's pull up fiscal year 2025. They reported $2.35 billion in revenue.
Which is huge.
It's massive. That is a 59% jump year over year. You don't just stumble your way into $2.5 billion of consumer healthcare spending. And they achieved their first full year of profitability with $128 million in net income. For a direct-to-consumer telehealth platform, actually generating a profit is a massive milestone.
It is. It proves the concept works. But, as analysts, we really have to look past that top-line revenue and examine the structural integrity of the business. Yes, they have about $577.49 million in cash, and they generated $300 million in cash from operations in 2025. But there are some underlying weaknesses in how that growth is actually being manufactured.
You're talking about the margins and the debt load.
Precisely. Let's look at their free cash flow margin, which is currently sitting at just 4.2%.
Wait, 4.2%. Let's translate that for anyone who doesn't spend their days staring at cash flow
What
statements.
did they do?
So free cash flow margin means that for every $100 in revenue, HIMS brings in, after paying for all their operating expenses, taxes, capital expenditures, they only have $4.20 left over as truly free liquid cash.
Huh?
That is razor thin. Why is it so low if they are making billions?
Because customer acquisition in the telehealth space is astronomically expensive.
Hmm.
I mean, HIMS has to spend heavily on digital marketing, social media ads, sponsorships, promotional pricing, just to get a patient in the door.
Right, those Instagram and podcast ads aren't cheap.
Exactly. And then they have to pay the network of doctors and medical professionals to conduct the asynchronous consultations. The unit economics dictate that they often lose money on a customer in the first few months. They are relying entirely on the lifetime value of that subscriber to eventually turn a profit.
Which perfectly explains the other glaring red flag in their financials, the debt.
Yeah, the debt is the elephant in the room.
Their debt-to-equity ratio right now is towering at 179.80%.
It's staggering. That means for every single dollar of equity the company has, they are carrying almost $1.80 in debt. They are heavily, heavily leveraging themselves to fuel that 59% revenue growth.
So they are borrowing money to buy customers, hoping those customers stick around long enough to pay off the debt.
Exactly.
So what does this all mean for the stock going forward? It sounds like this entire business model is a massive high-wire act. Like, as long as they're growing revenue by 50 or 60%, Wall Street will tolerate the debt because the future cash flows look massive. But if Amazon's $1 program suddenly makes it harder for him to acquire new customers, or worse, causes their existing customers to cancel, that debt becomes toxic very quickly.
And that high-stakes leveraged reality is exactly why the stock's price history is so incredibly volatile. This isn't a slow and steady utility stock.
Yeah.
It trades entirely on momentum and future expectations.
Just look at the 52-week swings. Back in July 2025, this stock was riding a wave of optimism and hit a high of $70.43.
A huge run-up.
Yeah. But fast forward to February 2026, and the bottom completely fell out. Dragged the price all the way down to a low of $13.74. And now, today, it has clawed its way back to roughly $30. It is an absolute battleground.
It really is. And looking at the order flow data tells us exactly who is fighting this battle. Right now, there is a fascinating divergence between retail investors and corporate insiders.
Right, so retail traders, everyday people managing their own portfolios, they're aggressively buying the dips. They look at a stock that used to be $70, see it trading at $30, and their immediate psychological reaction is that it's on sale. It looks like a massive discount.
Yeah, that's a very common retail mindset. But the data shows that corporate insiders at HIMS were actually selling shares in April 2026.
Insiders selling, that never feels good.
Well, insider selling always requires nuance, right?
Mhm.
Executives sell shares for a lot of reasons. Tax obligations, diversifying their personal wealth, exercising options. It doesn't automatically mean they think the company's failing.
Fair enough.
However, heavy insider selling during a period when the stock is already down more than 50% from its all-time highs, that is definitely a bearish signal. It suggests that the people with the deepest visibility into the company's daily operations do not believe a rapid return to those $70 highs is imminent.
Wow. And the broader institutional market seems to completely agree with those insiders, which brings us to arguably the most explosive data point we have today. According to MarketWatch, 34.46% of the stock's available float is currently sold short.
That is a staggering level of short interest. I mean, it's massive.
Let's break that down. When an investor shorts a stock, they are borrowing shares they don't own, selling them at today's price, and betting that the price will fall. That way, they can buy those shares back cheaper later, return them to the lender, and pocket the difference.
Exactly.
So having over a third of the entire tradable stock shorted means there are massive institutional funds placing really aggressive bets that HIMS is going to crash.
They are betting big on a failure. But here is where it gets really interesting for you as an investor. High short interest is a double-edged sword. Yes, it means smart money thinks the company's in trouble, but it also creates the exact mechanical conditions required for a massive short squeeze.
Oh, I love a good short squeeze setup. Let's explain the mechanics of a squeeze because it is crucial for understanding the current volatility here. I always compare the retail buyers and institutional shorter sellers to two trains heading toward each other on the same track. Someone has to flinch first, right?
That's a great analogy. Think of short selling like being in a crowded theater. The short sellers are all sitting in the dark, watching the movie, feeling very confident.
Hmm.
But if the stock price suddenly starts going up, say, because of a surprise positive earnings report, it is the equivalent of someone yelling, "Fire!" in that theater. The short sellers are legally obligated to buy shares to return the ones they borrowed, which means they all have to rush for the exit at the exact same time to limit their financial losses.
Right, but the exit door is incredibly narrow. If 34% of the stock needs to be bought back, and retail traders are holding on to their shares refusing to sell, there simply aren't enough shares available.
Exactly. And as the short sellers panic and scramble to buy whatever shares they can find, their own buying pressure acts like rocket fuel. It drives the price up even faster, which forces more short sellers to panic and buy. It is a cascading chain reaction.
We saw it with GameStop, we've seen it with Tesla. When 34% of a float is shorted, it is a literal powder keg. All it needs is a spark.
Right. And to see which train has the momentum and figure out if that spark is coming, we need to strip away the narratives. We have to ignore the headlines about Amazon for a second and look purely at the technical analysis. What are the charts actually signaling right now?
Okay, let's look at the key levels. According to Investec's technical breakdown, the stock has established a very strong support floor down in the $19 to $20 range. That's the level where buyers consistently step in and just refuse to let the price drop further. On the flip side, there is heavy overhead resistance at $41.
And if we look at the moving averages, they really help smooth out the daily chaos and reveal the underlying trend. Think of the daily price fluctuations like waves on a beach. Well, the moving averages show you if the tide is actually coming in or going out.
I like that.
Right now, the 50-day moving average is at $24.16, and the 200-day moving average is at $22.42.
And since the current price of $30 is well above both of those averages, the charts are flashing a clear, bullish signal. The tide is rising.
Exactly. Furthermore, the MACD indicator is sitting at 2.11 and maintaining a buy signal. The MACD measures the acceleration of a trend. The fact that it remains positive tells us that despite the 4% drop on the Amazon news, the broader upward momentum hasn't fundamentally broken yet.
But here's where it gets really interesting. I have to push back and throw a wrench into this bullish technical picture. The RSI, the Relative Strength Index, is currently reading at 70.88. The RSI measures exhaustion. Imagine a rubber band being stretched. An RSI over 70 means the rubber band is stretched incredibly tight. The stock is officially in overbought territory. It has run up too fast, and mathematically, it's due to snap back or cool off.
Which is exactly what we are seeing with this current, choppy volatility.
Oh.
But this raises a really fascinating conflict. If the moving averages in the MACD look so structurally sound, why does the short-term trend feel so heavy? Why is it under such intense pressure?
Right. If the technicals look so incredibly bullish, why is it struggling to break out?
Because technicals only tell part of the story. Charts cannot read the news. A moving average cannot calculate the psychological impact of Amazon launching a $1 GLP-1 program. Technical analysis tells you what has happened and what the math suggests might happen based purely on recent momentum.
But the macro environment is throwing sand into the gears. The charts say the stock wants to run, but the underlying business fundamentals are anchoring it down.
Exactly. And for the rest of the story, to understand how the market is weighing those fundamentals, we have to look at how Wall Street analysts are rating the company's actual intrinsic value.
And Wall Street is incredibly divided on this one. The consensus rating right now is just a hold, but the specific price targets, they are completely all over the map. You have analysts putting a high target of $68 on the stock, while others have a low target of $18.
That is a massive spread.
It is. The average sits at $31.86. Just recently, Bank of America raised its target to $25, which they still firmly label as a neutral rating.
When you see a spread that wide from $18 to $68, it is the textbook definition of institutional uncertainty. Analysts simply cannot agree on what this company's business model will look like in 24 months. And this uncertainty brings up a crucial debate regarding the stock's valuation.
Let's talk about the valuation debate, specifically the PE ratio, the price to earnings ratio. This is the classic metric for determining if a stock is cheap or expensive. A PE ratio essentially tells you how much you are paying today for $1 of the company's current earnings. Right now, HIMS has a PE ratio sitting high at 57.35.
Yeah, it's up there.
For context, the average stock in the S&P 500 usually trades at a PE of around 15 to 20. So mathematically, 57 is incredibly expensive. You are paying a massive premium. Yet, despite that sky-high multiple, Guru Focus gives the stock a GF score of 81 out of 100 and explicitly labels it as undervalued.
Which sounds totally contradictory, right?
Yeah. How does that make any sense? How can a stock trading at 57 times its earnings be considered undervalued?
Well, this is the core debate you have to wrestle with. Is HIMS truly undervalued, or is it a value trap? Let's define the difference here. If HIMS can maintain that 59% revenue growth, aggressively expand its market share in weight loss and personalized care, and eventually improve its cash flow margins, then 57 times earnings is actually a bargain today.
Because their future earnings will be massive. You are buying the future, not the present.
Exactly. But a value trap is the exact opposite scenario.
A value trap is like buying a beautiful mansion at a huge discount, only to discover the foundation is sinking into a swamp.
That's a perfect way to put it. Retail traders often look at a stock that has fallen from $70 down to $30 and assume the worst is over. It looks cheap relative to its own history.
Right.
But a PE of 57 requires near-perfect business execution. The market is still pricing in massive growth. If HIMS stumbles, if their customer acquisition costs skyrocket, or if Amazon successfully seals their market share, their earnings will collapse. And if earnings collapse, that 57 PE ratio suddenly looks catastrophic. It's a value trap.
So let me ask you, the listener, directly. Think about your own perspective right now. Are you looking at a bargain, a temporary discount on a growth juggernaut? Or are you looking at a shiny object that's about to drop and masking a deteriorating foundation?
To figure out which side of the trap we are on, we have to map out the absolute best and worst case scenarios for the actual business.
Let's do it. Let's start with the bear case.
Okay, the bear case. This is the worst case continuation lower. It relies on the assumption that telehealth is ultimately a commodity business with no real moat. In this scenario, Amazon's $1 GLP-1 program absolutely destroys HIM's ability to charge a premium. If consumers realize they can get the exact same active pharmaceutical ingredients through Amazon's massive trusted distribution network for a fraction of the cost, they will switch.
And if they switch, HIMS has to slash its prices to compete. That razor-thin 4.2% free cash flow margin we talked about earlier, it completely vanishes. They start burning cash just to keep the lights on, and suddenly that 180% debt-to-equity ratio becomes a crushing weight. And honestly, the 34% short interest proves that a massive segment of institutional Wall Street believes this exact scenario is currently playing out. Plus, the insider selling points to a lack of internal confidence.
Right, that's the bear case. Now let's look at the bull case, the best case recovery scenario. This argument hinges entirely on the idea that HIMS is not just a pill dispenser, but a specialized healthcare ecosystem.
Let me counter with the bull arguments here. The strongest weapon in their arsenal is their subscriber base. They currently have over 2.5 million recurring subscribers. In the e-commerce world, an isolated purchase is great, but a subscription is the holy grail. It's a financial fortress. You have 2.5 million people whose credit cards are charged automatically every single month. It provides massive stability and financial predictability.
That is true. But we have to question the structural integrity of that fortress. Are health subscriptions really that sticky? I mean, if you subscribe to Netflix, it's hard to replace because they have exclusive content. But if you subscribe to HIMS for a generic medication, and Amazon makes it frictionless to switch your prescription with one click for a lower price, that recurring revenue can evaporate much faster than the bulls want to admit.
I wonder if Amazon is the siege engine capable of breaking those walls. But, HIMS knows this. That is exactly why they are diversifying away from just competing on drug prices. They are moving heavily into the longevity space, customized hair loss treatments, erectile dysfunction, and highly personalized dermatology. They are trying to create a bespoke medical experience that Amazon's bulk distribution model simply cannot replicate.
And whether that pivot works will ultimately be decided by two massive impending catalysts. If you are tracking this stock, you have to separate your outlook into short-term hurdles and long-term binary events.
Let's flag the short-term outlook first. The immediate hurdle is their first quarter earnings report. which is due right around the corner on May 11th, 2026. The company previously gave guidance stating they expect total revenue for 2026 to land somewhere between 2.7 and 2.9 billion dollars.
That May 11th call is going to be critical. It will be the first real look under the hood since the Amazon news dropped. The market will be aggressively looking for any signs that customer churn is increasing or that guidance is being lowered.
Yeah.
If they miss those projections, the short sellers will absolutely press their advantage.
But even if they survive the earnings call, there's a much larger make-or-break catalyst looming in the long term.
Yes, and this is the event that could fundamentally alter the trajectory of the company. On July 23rd and 24th of 2026, the FDA is holding advisory committee sessions.
This is huge.
It is the most crucial piece of the puzzle. The FDA will be reviewing broader access to 12 compounded peptides.
Let's explain how this works because it is the hidden engine behind a lot of HIMS's recent growth. Brand name GLP-1 weight loss drugs like Wegovy and Ozempic have been in massive national shortages. Because of that shortage, the FDA allows special compounding pharmacies to create custom, unbranded versions of these medications with the same active ingredients.
Right.
This legal gray area allows companies like HIMS to sell affordable compounded weight loss drugs entirely legally.
But that loophole only exists as long as the FDA recognizes an official shortage. If the FDA Advisory Committee in July decides that the national shortage is effectively over, or if they choose to restrict access to these specific 12 compounded peptides for safety reasons, it would be devastating. HIMS could lose a massive, highly profitable revenue stream practically overnight.
Wow. But on the flip side, what if the FDA ruling favors broader access? What if they provide clear, long-term regulatory approval for these compounded treatments? This regulatory shift could be a massive revenue unlock.
That is the ultimate bull catalyst. It would provide HIMS with regulatory clarity, allowing them to aggressively scale up their personalized medicine offerings without the constant threat of a government crackdown.
So let me ask you this. If that happens, if HIMS suddenly gets a permanent green light to dominate the compounded peptide market, would a positive FDA ruling be enough to trigger that massive 34% short squeeze?
Oh, absolutely. It is the exact type of binary, high-impact, fundamental shift that forces short sellers to cover their positions. If HIMS can maintain its subscriber base through the May earnings and then secure a regulatory victory in July, the mathematical pressure on those short sellers trapped in the theater will be immense. The race for the exit would be historic, but again, that requires surviving the brutal margin pressure from Amazon between now and then.
Which perfectly summarizes the incredible, high-stakes uncertainty surrounding this company right now. On one side of the ledger, you have brilliant 59% revenue growth, a sticky base of 2.5 million loyal subscribers, and the potential for a massive FDA catalyst that could trigger one of the biggest short squeezes of the year.
And on the other side of the ledger, you have the looming shadow of Amazon Pharmacy actively trying to destroy their margins, a towering 180% debt-to-equity ratio that limits their financial flexibility, incredibly thin cash flow, and over a third of the market actively betting against their survival.
HIMS is no longer trading purely on its current fundamentals. It has become a binary event. It is a high-wire act with Amazon shaking the wire and the FDA waiting at the end. We've laid out the mechanics of the debt, the charts, the short interest, and the regulatory loopholes. Now it is up to you to weigh the data against your own strategy. And please remind us what you think. Hit the like button, subscribe, and leave those mandatory comments on the YouTube video to share what you think about the stock.
We have covered a tremendous amount of ground today, but I'm going to leave you with one final provocative thought to mull over as you analyze this space. If the FDA ruling in July completely opens the floodgates for these 12 peptides, will Amazon's vast distribution network swallow the entire market? Or does HIMS's massive 2.5 million subscriber base give them the ultimate head start? Who really wins the war for the future of personalized medicine?